If you're over 65 and you filed your taxes the exact same way you did last year, there's a very good chance you just handed the IRS money that was legally yours to keep. Not because you did anything wrong, because the tax code changed and almost nobody sent you a letter about it. Quick heads up before we get into it. This is general education, not personal tax advice. And now let's get into surprise number one, because this one alone could be worth thousands of dollars this year. Here's the situation. Every year, the IRS updates dozens of rules that apply specifically to people over 65, and every year, the vast majority of retirees keep filing the way they always have. Same deductions, same withholding, same blind spot on the same line of the same form. Meanwhile, the rules keep shifting in your favor, and the IRS is under zero obligation to tell you about it. They publish it. They don't promote it. There's a difference. Think about what that actually costs over time. A missed deduction of a few $1,000s a year doesn't sound catastrophic in the moment, but stretch that across a 15 or 20-year retirement, and you're talking about tens of thousands of dollars that quietly slipped through your fingers because nobody told you the rule existed. That's not a rounding error. That's a car. That's a grandchild's tuition payment. That's a cushion you didn't know you were allowed to have. I want to be specific about where these rules come from, because I don't want you taking my word for anything. Some of what I'm about to walk you through comes straight from the IRS's own instructions for Form 1040 and Publication 554, which covers tax guidance specifically for seniors. Some of it comes from the Secure 2.0 Act, which Congress passed in December of 2022, and which is still phasing in new provisions year by year. And one of the biggest pieces comes from a much more recent law, the tax legislation passed in the summer of 2025 that created a brand new temporary deduction specifically for people 65 and older. That last one is so new that a lot of tax preparers themselves are still catching up on it. So if your accountant hasn't mentioned it, that's not necessarily their fault. It's new, but it's real, and it's on the books right now. Let's go through this one at a time. 7 things. Some of these apply no matter your income. A few are means tested. By the end, you'll know exactly which ones apply to you and exactly what to do about each one. Number 1, the new senior bonus deduction. Here's the rule in plain terms. On top of your regular standard deduction, and on top of the extra deduction you already get for being 65 or older, there is now an additional temporary deduction of up to $6,000 per person if you're 65 or older, available for tax years 2025 through 2028. If you're married and both spouses are 65 or older, that's potentially $12,000 combined, on top of everything else you're already claiming. Here's the real dollar impact. Picture a married couple, both 68, taking the standard deduction. Before this new provision, their standard deduction plus the existing age 65 addition already put them in a decent spot. Add the new $6,000 per person bonus deduction, and depending on their tax bracket, that can mean $1,200 to $2,600 or more in actual tax savings, not deductions, savings, in a single year, just for existing and being over 65. Now here's where it gets important. This deduction phases out at higher incomes. For a single filer, it starts phasing down once your modified adjusted gross income crosses roughly $75,000, and it phases out completely somewhere north of $175,000. For married couples filing jointly, the phase-out starts around $150,000 and fully disappears somewhere north of $250,000. Those are the general shape of the thresholds. The IRS finalizes the exact phase-out math each filing season, so you'll want to confirm the current year numbers before you file. But if you're a typical retiree living on Social Security, a modest pension, and some IRA withdrawals, there's a strong chance you're well under those limits and entitled to the full amount. Most retirees do one thing wrong here. They let their tax software auto-apply the standard deduction without checking whether the new senior bonus was actually included, especially if they're using older software or a preparer who hasn't updated their checklist yet. Ask directly. Say the words senior bonus deduction or additional deduction for age 65 and older under the 2025 law. Make them confirm it's on your return. Number 2, qualified charitable distributions from your IRA. Here's the rule. If you're 70 and a half or older and you have a traditional IRA, you can transfer money directly from that IRA to a qualified charity, and that money is excluded from your taxable income entirely. It doesn't show up as income on your return at all. The annual limit is currently around $105,000 to $108,000 per person, adjusted for inflation most years, so for the overwhelming majority of retirees, that ceiling is never even close to being a constraint. Here's the real dollar impact, and this is the part people miss. If you're 73 or older, you're required to take a minimum distribution from your IRA every year, called a required minimum distribution, or RMD. That distribution is taxable income, whether you spend it or not. But if you donate that money directly from the IRA to a charity using a qualified charitable distribution, it counts towards satisfying your RMD for the year, and it never touches your taxable income. Picture a 75-year-old with a $40,000 RMD who already gives $8,000 a year to their church or a favorite nonprofit. If they take the $40,000 as regular income and then donate the $8,000 separately, they pay full tax on the entire $40,000, and they only get a partial benefit from the charitable deduction if they even itemize at all. But if they direct that $8,000 straight from the IRA to the charity as a qualified charitable distribution, they only pay tax on $32,000, and the transaction doesn't depend on whether they itemize deductions or take the standard deduction. That's the trap. Most retirees no longer itemize, which means their charitable giving through a regular check gets them nothing on their tax return. A qualified charitable distribution gets them a real benefit regardless. The mistake almost everyone makes: they write the check personally, then try to deduct it, not realizing they need to have the money moved directly from the IRA custodian to the charity. If the check comes from your personal account, even if you're reimbursing yourself from the IRA, it doesn't count. Call your IRA custodian and ask them specifically to process a qualified charitable distribution sent directly to the organization. Number 3, the Social Security taxation trap, and the fact that the thresholds haven't moved in over 40 years. Here's the rule most people don't fully understand. Up to 85% of your Social Security benefits can be taxed, depending on your total income. The thresholds that determine this were set back in 1983, and here's the part that should bother you. They have never been adjusted for inflation since, not once. For an individual, once your combined income crosses $25,000, part of your benefits becomes taxable. Cross $34,000, and up to 85% becomes taxable. For a married couple filing jointly, those numbers are $32,000 and $44,000. Now here's the real dollar impact. Because those numbers were frozen in 1983 and never indexed to inflation, more retirees cross that line every single year, even though their actual purchasing power hasn't grown. If those thresholds had simply kept pace with inflation since 1983, they'd be roughly 2.5 to 3 times higher today. Instead, a retiree with a modest pension and some part-time income can easily find themselves paying federal tax on benefits that a retiree with the identical real income never paid tax on a generation ago. Here's the part they never tell you. Combined income for this calculation isn't just your paycheck or pension. It's your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. That last piece catches people off guard constantly. Even municipal bond interest, which is federally tax-exempt, still counts toward whether your Social Security gets taxed. What most retirees do wrong is they take their full IRA withdrawal or RMD in one lump sum without thinking about how it interacts with this threshold, pushing benefits that would otherwise be tax-free into the taxable zone. A better approach many retirees use, with guidance from a tax professional, is spreading withdrawals more evenly, doing partial Roth conversions in lower income years before RMDs kick in, and timing large one-time withdrawals, like a home sale gain or a big capital gain, in years where it won't stack on top of Social Security and drag more of your benefit into the taxable range. Number 4, fixing an inflated Medicare premium with Form SSA-44. Here's the rule. Your Medicare Part B premium is based on your tax return from 2 years ago. If your income has dropped since then, because you retired, because your spouse passed away, because you stopped working, because you lost a pension, the Social Security Administration has a specific form that lets you request a recalculation based on your current, lower income, instead of waiting for the 2-year lag to catch up on its own. The real dollar impact here can be enormous. At higher income brackets, the income-related monthly adjustment amount, known as IRMAA, can more than double or triple your monthly Part B premium. For a couple who both retired from full-time jobs last year, their Medicare premiums right now may still be calculated off the working income they earned 2 years ago, not the retirement income they're actually living on today. That mismatch can cost a couple thousands of dollars a year in premiums they don't actually owe based on their real current income. Here's a concrete example. Say a 67-year-old retired in the past year after decades in a corporate job, and their household income dropped from around $180,000 to around $65,000. Social Security is still looking at that old $180,000 figure, which may be triggering a significant IRMAA surcharge on their Part B and Part D premiums. Filing Form SSA-44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, and attaching documentation, like a retirement letter or a pension statement, lets them ask Social Security to base the calculation on this year's much lower income instead. The mistake almost everyone makes is assuming there's nothing they can do until the lag catches up naturally 2 years later. That's simply not true if you've experienced one of the qualifying life-changing events, which include work stoppage, work reduction, marriage, divorce, death of a spouse, loss of pension income, or loss of income-producing property. You go to SSA.gov, search for Form SSA-44, fill it out, attach your proof, and submit it to your local Social Security office. There's no fee, and there's no downside to asking. Number 5. The RMD rules changed, and the penalty for missing one got dramatically smaller. Here's the rule. Thanks to the Secure 2.0 Act, the age at which you must start taking required minimum distributions moved from 72 up to 73, and it's scheduled to move again to 75 starting in 2033. That alone gives many retirees an extra year or more of tax-deferred growth before they're forced to start pulling money out and paying tax on it. But here's the part that really matters, and almost nobody has caught up on it yet. In the past, if you missed an RMD or took less than required, the penalty was a brutal 50% excise tax on the amount you should have withdrawn. Under the new rules, that penalty has been cut to 25%, and if you catch the mistake and correct it within 2 years, it drops further, down to just 10%. Think about the real dollar impact of that change. Under the old rules, a retiree who accidentally missed a $10,000 RMD could owe a $5,000 penalty on top of the regular income tax. Under the current rules, that same mistake, corrected promptly, might cost $1,000 instead of $5,000. That's a massive reduction in the cost of an honest error, and most retirees, and frankly a lot of financial advisors, are still operating as if the old 50% penalty is in effect. What most people do wrong here is either panicking unnecessarily over an old RMD mistake without realizing the penalty structure has improved dramatically, or assuming the RMD age is still 72 and taking a distribution a year earlier than they're required to, paying tax sooner than necessary. Check your current RMD age based on your birth year, and if you've ever missed one, talk to a tax professional about filing Form 5329 to request the reduced penalty and, in many cases, a full waiver if you can show reasonable cause. Number 6. The saver's credit if you're still working part-time or your spouse is. Here's the rule. If you or your spouse have earned income and you're contributing to an IRA or a 401k, even a modest amount, you may qualify for the Retirement Savings Contributions Credit, commonly called the Saver's Credit. This is a direct credit against your tax bill, not just a deduction, worth up to 50%, 20%, or 10% of your contribution, depending on your income, up to $2,000 in contributions per person. A lot of retirees assume this credit is only for young workers starting their first job, but there's no age cap. If you're 68 and working 15 hours a week at a part-time job, or you have modest self-employment income and you're putting a portion of that into a retirement account, you could qualify for a credit worth several $100s directly off your tax bill. The real dollar impact for a lower income retiree who qualifies for the full 50% credit and contributes $2,000 to an IRA could be a $1,000 tax credit. Even at the lower tier, a $2,000 contribution could still generate a $200 credit. That's real money, dollar for dollar off what you owe. The mistake here is that most people assume any retirement contribution credit is off the table once you're retired. If you have any earned income at all, even part-time, check whether you qualify before assuming this doesn't apply to you. Number 7. The $2,000 cap on prescription drug costs and the extra help program that goes with it. Here's the rule. As of 2025, Medicare Part D now has a hard annual cap of $2,000 on out-of-pocket prescription drug costs. Once you hit that number in a calendar year, covered medications cost you nothing for the rest of the year. For decades, there was no ceiling at all, and seniors managing serious illnesses could pay tens of thousands of dollars annually. That era is over, but you need to actually know the cap exists to plan your medication budget around it. On top of that, there's a separate program called Extra Help, or the Low-Income Subsidy, that can reduce your Part D premiums, deductibles, and copays to nearly zero if your income falls roughly under 150% of the federal poverty line. For a single person, that's approximately income under $23,000 a year. For a couple, roughly under $31,000. If you qualify, this isn't a small trim. It can eliminate almost the entire cost of your prescription coverage. Most retirees have never applied for Extra Help because they assume, incorrectly, that it's the same thing as Medicaid or that it will somehow affect their other benefits. It won't. It's a separate one-page application through the Social Security Administration, and it does not reduce your Social Security check or your Medicare coverage in any way. That's 7. The new senior bonus deduction, qualified charitable distributions, the frozen Social Security taxation thresholds, fixing an inflated Medicare premium with Form SSA-44, the updated RMD age and reduced penalties, the Savers credit for part-time earners, and the $2,000 prescription drug cap paired with Extra Help. If you only do one thing after watching this video, do this. Pull out last year's tax return this week and specifically check one line. Did your return include the additional standard deduction for being 65 or older? And did it include the new senior bonus deduction if you qualify based on income? That single check, done this week, either confirms you're already getting what you're owed, or it flags a mistake worth going back and fixing with an amended return. Every one of these 7 things has one thing in common. The IRS and the Social Security Administration will not call you to apply these rules automatically. The forms exist. The thresholds are published. The law already says you qualify. The only missing step is you actually claiming it. If this helped you see something you'd been missing, subscribe, because every week I break down another piece of the tax code that's written for retirees, but never explained to them in plain English. And next week I'm walking through exactly how required minimum distributions interact with Roth conversions, and the narrow window in your 60s where converting can save you tens of thousands of dollars over the rest of your retirement.